You see a bunch of these, the market's, prime and ready to go and ready to switch direction from a downtrend to an uptrend.
You want to be as specific as possible.
Never position size above 50% or half of your account at once.
How do you analyze the market environment, put that into words, into rules, and then how do you trade as a result of that market environment?
That's not going to happen overnight or by reading a book.
You should keep your equity losses ideally less than 1%.
And I think stage 1 and 2 traders should always have all their trade ideas be determined before the open.
So manage risk in real time, act in real time, take into account what's going on, not what you hope will occur later on in the future. Welcome everybody to the 10th and final Ultimate Trading Guide, a webinar. We're super excited for this one to really wrap up the series with a really important topic, as well as kind of summarize a lot of the key sections that we've already covered in previous ones. We'll be discussing creating trading rules and future growth. As always, this is recorded and it will be uploaded, and we'll send out the link by email. And if you're just watching the replay, make sure you leave a like on this video, subscribe to the channel. We put a lot of work into this, and hopefully you guys are finding it extremely valuable. And we've got some great stuff to talk about at the end as well. So welcome everybody to Framework 10, Creating Trading Rules and Future Growth. Moving on, we've got our Ultimate Trading Guide pledge. We're bringing this back here. At the start of this series, we mentioned that you guys really have to put in the work as well. It's not just on our side to present the material. You should fill out this pledge for yourself, sign it on a piece of paper. We'd love to see tweets at us, with this pledge. But basically, here it goes. I blank, insert your name there. Will do my utmost to make incremental improvements and put in the work that will allow me to learn and improve as a trader. I will establish routines, read books, conduct studies, and otherwise look for ways to extend my knowledge base and perform at my best. We can, give you all the secrets, but if you don't actually put in the work, establish your system, build a trading rule set, which is what today is all about, everything is mute. You have to put in the work and apply the material that we're presenting. Rai, any last words, since the last time we'll be bringing up this pledge? Anything that you want to add here?
No, I think, many of you have stuck around, right? We have quite a few people that have watched the whole series. I think that it begins with that. And then from there on, it's about applying these principles or these frameworks, right? The more you apply them, the better you will get at them. And the better you get at them, you'll see improvements and more importantly, results in your trading as well. So, yeah.
Yep, sounds good. And then once again, if you haven't yet downloaded the Ultimate Trading Guide, I'll drop the link in just a second into the description. But this is an excellent free resource. The link should be popping up right now. It should be in the description for people watching the replay. But we spent several months putting this together. It kind of is a written format of what we've been presenting, but in some ways goes even into more depth. Tons of setup examples, chart examples, and we cover a lot of really essential topics. So go ahead and check this out if you haven't already. And with that, I think we can, I'll hand it over to you, Rai, but first, reading this quote here, I think this applies, not to just this webinar, but the whole series in general. This is from William O'Neill. 90% of the people in the stock market, professionals and amateurs alike, simply haven't done enough homework. So today is all about writing rules and kind of encompassing your system into a written format. And this accomplishes several things. Not only does it create a resource that you can refer back to, but it also forces you to think about different scenarios, think about areas where you're weak in, where you're strong in, and bring everything together in one single place. And you won't really understand or recognize the gaps in your system if you don't go ahead and do this process. So I 100% think, especially for newer traders out there, you should create this rule set before you place a single trade. Obviously, it's going to be a starting point. You'll always be iterating along this, but you have to put in the work and put this together. This is kind of your business plan, as we'll get into, that describes how you're trading. Rai, anything that you want to add here about?
Yeah, and I think some of this quote is always kind of misinterpreted. And the way you read it as a stage one trader, you might take offense to it. But stage three traders do not take offense to this because they went through being in that 90%. So the only thing I would add to this is the word homework refers to the 9 frameworks we basically covered over the last 9-10 weeks. And it's a package. It's not, hey, I did my homework or I did my routine. Now I have to see results, right? It's not like that. It's more so those 9 frameworks being applied and doing homework on each of those frameworks for you to get out of that 90%. So William O'Neill's quote here is after he did his research and he said, when I did all of that work, I then saw results. And then that's the reason he kind of said this is, I just see a lot of people not putting in the work that he put in, right? And that's why they're not successful in the markets. So if this applies to you, and I see a few comments in the chat, then you at least the first step is to realize the fact that you haven't done enough of it, and then work your way towards it.
Yeah, so here's a little bit about what we'll be covering today. First, the process and how to actually go about writing trading rules, getting a little bit into the details there. And then we're going to kind of run through almost a summary of all those 9 webinars that we've done so far. But each of those different topics kind of represents a section of your rule set that you should have. And you might see there after sell rules and position management, we've got another section, additional section on kind of miscellaneous and emergency rules that you should have in place. Definitely an important part of it. And we haven't really covered that yet. And then after running through these different sections, we'll move on to some further resources as well as try to answer as many questions that you guys have. So yeah, this will be a lot of fun. And before we get started and dive in, I do want to ask everybody watching right now, leave in the chat here, do you have a full written rule set, written out? Have you thought through all these different sections? And also, is it updated? I think that's a common thing as well. People might do this once. It might not be completely complete, and then they kind of get away from it and don't iterate on it with every new market cycle and as they gain more experience. So I see a lot of yeses, which is great. And for those of you who don't, that's perfectly fine. Everybody has a starting point, and that's kind of the purpose of today's video, is to give you a head start, a foundation that you can build from as you write your full rule set. And as always, this is kind of the skeleton that you can use and build off of and add kind of meat to it. But these, to me, are kind of the key sections that each rule set should encompass. And this actually goes all the way back to when I first started to learn how to trade back in 2019 with Dr. Wish. One of his first assignments is for us to write our first rule set. So this is kind of an iteration off of that. That's from a trader who's been doing this for 5+ decades. So I think with that, let's go ahead and jump right in. All right, so writing trading rules. First, trading, if you want to really compound and grow your capital over time, it is a business. It's a business with margins. It's a business with edge, all of that. And you have to have a business plan that describes how you're going to go about it. What's going to set you apart, how are you going to enter, exit, everything that we already covered in the previous section. And what I already mentioned is that this is a living document. It's not just going to be something that you create once and you're done. You're always going to be iterating off of it, adding new sections, taking stuff away, simplifying some aspects, getting more into the weeds in others. And overall, as you mature as a trader, you'll see your rule set mature as well. Again, I think I mentioned Mike Webster last weekend. He's probably on iteration 30,000 or something of his rule set. And every trader is constantly learning, refining their process, and your rules should be kind of reflecting that growth as well. A key thing that I want to emphasize as we go through this is when you're writing this rule set, you want to be as specific as possible. Your rules should be written in a way that a trader of a similar knowledge level to you could follow them and get the same result as you. So that means instead of just saying I'm gonna size up when the market gets good. Well, what does size up mean? Be specific. Are you going to increase your position size 5%? Are you going to increase it 2%? What does the market get good mean? Like, is that when we retake moving averages, when leaders are breaking out? All that stuff should be taken into account. Um, so that it's specific enough that another trader could follow it. And this isn't just for the sake of, making it more complicated. It's for the sake of becoming more precise and thinking through how actually you're going to go about it, because writing it in that way forces you to think about different possibilities and, create rules that meet those different possibilities. Along with that, especially for your first rule set, I would say start as simple as possible. We got into this a little bit when we talked about market cycles. You don't want to be taking in 15 different factors to begin with. Get a first iteration, first prototype of your rule set out the door as simple as possible that condenses your system. And then from that point, from that starting point, you can go ahead and update it based on your experiences, mistakes you make, lessons you learn, as well as different places where you learn more about trading, whether that's webinars like this one, books you read, or of course your own kind of market feedback, market experience. So, Rai, anything you want to add on this slide?
Yeah, I think just to start with, have some rules for when you will exit your position. I think, a simple one such as I will exit, my stop loss should be no more than 3 to 5% for swing traders, right? Usually for position traders, it's 7 to 9%. So, and make some, parse out your rules into, I would say, two sections. One would be depending on the situation, you act accordingly. And then the other is non-negotiables, right? Your non-negotiables are what's stopping you from moving to the next stage, from stage 1 to 2 and 2 to 3. Where if you write them down as stage 1, hey, I will not trade the market on the long side when the NASDAQ is below its 21 EMA, right? Just that simple one alone, if you stick to it and you kind of put yourself through the paces of, just developing that patience, it will allow you to be a stage 2 trader a lot sooner. So I would say some of you need to have those non-negotiable ones right away, write them down, and then make sure you adhere to, like, you follow them, because you'll see some of the results, right, from that. And then over time, you will get very fancy with to a point where you might sell stuff into strength for absolutely no reason, even though you don't have a rule written down. But to get to that state, you need to get out of your current state, which is the stage 1 and 2. So other than that, I would say the be Pacific part is very important, because that will allow you to really implement, right? If you say, like Richard said, when the market's good, I will do this. Good can mean a lot of things. And then especially when the market's trading live and it's open, then good is depending also on your mood and what you think, and FOMO and all these other things that they can possibly creep in. So it's just kind of those two things. I would say have non-negotiables one, down. You can make a list, post it, or tag me, Richard and I. We're happy to review it and maybe develop it with you, right, on social media and stuff. So yeah, I think that's the most important.
Yeah, I'd agree. The risk management rules, especially at the very beginning, those are the most important to focus on, and we reemphasize that a lot during this presentation. So moving on to the next slide, we've got some examples. So this is kind of a bad example of a rule that might write. If the market is in a downtrend, I will trade smaller. To me, that's just not specific enough. I mean, Rai, you might interpret that in a completely different way than I would. Somebody else might as well. And you kind of have to ask yourself, after you write a rule, could a trader of a similar knowledge follow it and kind of get the same result as you? And again, the goal of this is not just to add more work to you. The goal is to fully think through your process and think through different scenarios and all of that. You'll be amazed about, how you don't really actually have a plan for a specific situation. What happens if a stock gaps down through your stop the day after you buy? If you don't have a plan for that, then in the moment you're caught off guard. You're going to let emotions, really direct what you do. And so, the better way to go about it is to have a business plan ready for that scenario that then you can apply it. So a kind of a better example of, kind of describing that same thing. If the QQQ is below a declining daily 21 EMA, then I will have my normal position size, which is 12.5%, until the QQQ retakes the moving average, or 4 out of 5 of my last trades were winners. That's specific. A trader could follow that and kind of understand exactly what you're doing. So again, I hope you guys can see the difference between being, not very specific and being very specific and fully thinking through what does a down market look like, and how will that impact how I trade? How will I trade as a result of that different market environment?
Perfect. Yeah. And then I would say the other portion of this is once you write it down, then you will deliberately act on it, because there's no other choice, because you're kind of creating a contract with yourself, right? It's very similar to when we say the word business plan. If you've ever signed an agreement of some sort, they always cover every specific situation very clearly as to, if this were to trigger or a clause were to trigger, this is what the actions or the consequences will be, right? It's very similar when it comes to trading as well. If the Qs decline below the 21 EMA, then your position size has to go down, because you've seen this in the numbers, right? And if you were to write it down and make a whole plan around that, as part of your trading business and how you will approach it, that deliberate action will allow your equity curve to kind of stop declining, and you'll take things more seriously. You'll see the results, and as soon as you see kind of a taste for how the market works and how you can win in the markets, you will make more and more rules. Like people kind of find, some of these experienced traders crazy because they have hundreds of rules, but all of those are over a span of time, and those rules allow them to win a lot more in markets at the end of the day. So that's why they keep implementing different nuances, and say, in this situation, when I trade the Fed, this seems to happen. When I trade biotech stocks, I'm not good at it, so I shouldn't trade biotech stocks. When I trade the stocks from, let's say, I know some people that will not touch any Chinese names because they haven't had good experiences in the past. Now that's another situation, a kind of a rule. It's almost like a mental rule, right? But you could write it down as well. And now they're just trying to find ways that the market continues to take money from them, and avoid those instances, and add them to their rule sets over time. And that's what allows them to be a lot better and win a lot more in the markets.
Yeah, so going back to what you should include in your overall rule set, again, this is kind of an organization, a skeleton that you kind of can start with. Maybe you want to add a section, maybe you want to take one away, that's fine. But I think this does a good job of covering kind of 95% of your trading system that you need to build. And I saw a question from Michael. How do you handle a situation when you don't have a plan or rule for? Well, I try to do the best I can in the moment, and then I make a rule about it, the next day, pretty much. There's always more things that you can learn. My first gap down out of nowhere, I made a rule after that, how to handle that. But first and foremost, if it's a situation that I don't have a plan for, risk management is the number one thing on my mind. And then, I go from there. Ryan, any other sections that you think might be helpful for people to include in the rule set, or things you want to emphasize, like how risk management for stage 1, 2 traders, maybe that's the first section that they should write, or what they should focus on?
I would say the question by Michael is a pretty good one. You can review some of the traders, that you follow and know, right? Some of their rule sets, some of the famous ones that are written in books as well, right? There's always a reason as to why, and that reason is usually almost always a result of a loss in the markets, right? So that's kind of the essence of why rules even exist, and we're trying to stop ourselves from ourselves. So you can always go out, and I would say that's what I like doing. Like when you read books and stuff, Minervini's books, John Boyke's books, pretty much any book that's related to some sort of success at the end of the day in the markets will tell you indirectly, don't do this, don't do that, don't do, they will always give you that indirect communication throughout as you read it. So those resources are always good as well. So you don't have to build yourself from scratch, go through a gap down for you to build a gap down rule, I would say. But if when you experience it for yourself, you should have some sort of idea, hey, if I'm caught in this situation, it's inevitable. It's going to happen. It happens to everybody. You should have some sort of framework. But then when you experience it for the first time yourself, what will happen is you'll tweak that because now you've experienced it, you know what's going on, and you will have your own kind of twist or flavor on that rule, and which you borrowed from someone else, for example. So perfect. I don't have much else to add here, Richard.
Yep. So I think we can move on now, and we'll be again kind of covering a lot of what we've already talked about from a high level here, and trying to answer as many questions as we've seen come through, and also talk about applying it and creating a rule around it, right? So when it comes to market analysis, this to me is kind of the first important rule section. A lot of people when they're first learning to trade, what's the first thing they do? They memorize a bunch of candlestick patterns, right? They're focused on entry tactics. But I'm sure all of you, listening to this, or you soon will, you'll kind of recognize that it's a lot more about the market environment that impacts things a whole lot. It goes market, group, stock, and then setup, entry tactic, all of that. So from a market analysis perspective, again, start simple with your rules. I think, for my time frame, the 21 EMA is super helpful as kind of a risk on, risk off indicator. Above it, we're good. Below it, things have to be a little bit more, you have to be a lot more defensive, but you can also take into account volatility, expectation breakers. The past week, I would say, has been pretty much an expectation breaker, and that happened below the 21 EMA. So you might want to include a section, kind of an exception about expectation breakers after an event like the Fed or something similar to that, or a key price and volume signature. So for me, you should have rules that define how you'll trade differently in uptrends, downtrends, neutral/choppy markets, and define what each of those means to you. How will that impact your aggressiveness, the number of trades you take, your position size, all of that. Maybe you have a rule that when we're in a downtrend, you can take max 3 trades, and then you kind of wait and see how those act. And then if they act well, then maybe you can take another. But just think through, at a high level, how do you analyze the market environment, put that into words, into rules, and then how do you trade as a result of that market environment?
Perfect.
Yep. And a part of that can 100% be, leadership analysis. That's what I do as well. I keep a running list of, the top leadership, and I take a look at, how did they perform on the week? Are they trending? Are they gapping up, gapping down, breaking out, consolidating, all of that? You also have to kind of define for yourself, how will you find those leaders? How do you define a market leader? Everybody's going to be a little bit different. These are some ideas. It can be based on recent power gap ups, strong price strength the past month, past 3 months. They can be a part of leading groups. And then once you've defined that and you have kind of a process that somebody of a similar skill level could follow to find pretty much those same leaders, then you can write about how you will incorporate those leaders into your market analysis, whether that's how many are above a moving average. You could kind of have a metric based on that. The percentage that are, above their 50-day, whatever it is, their daily performance, their trends, all of that. So once again, you can incorporate this into your kind of market environment, market analysis rules. I think it's super helpful to kind of have this qualitative analysis coupled with kind of more objective analytical analysis of the market indexes. And Ryan, I know you incorporate kind of gauges. You kind of pick different stocks as gauges. So maybe you can kind of add how you use that into your and incorporate that into your process.
Yeah, so with stock gauges, the way it just kind of works, I would pick, some of the top leaders in the markets. Let's say from May to September this year, we had Nvidia as one of them, right? And even on this rally, when Nvidia reclaimed the 10-day, at that point the rally really, got going. It was day 2 and day 3 of that rally. So they're just, levels that I feel are important on leadership stocks. So leadership stocks are stocks that would lead, are going to lead this uptrend or lead a theme in the markets. And then I just look at, hey, if Nvidia is about 400, I'm still good, right? And then when this is about to crack that key level, then what tends to happen is everything around it in the markets will eventually be bogged down as well. So it's just another way of keeping track of how leadership is doing by looking at some of the key levels, and usually just whole numbers, right? Is it above 100? Is it above 50? Is it above 300, 400, etc.? And usually when your leadership stocks are below your gauges of what you feel they have to trade above for the market to be good, when they start moving below, the rest of the market usually follows suit and kind of, heads down basically.
Yeah, this leadership analysis, it almost leads the market analysis, right? And it's closer to what your portfolio should be feeling almost. So again, just want to stress that this is super important. Then, we talked about components of market cycle. If you want the details, definitely rewatch that full webinar. But again, you want to have trend definition for what's an uptrend, what's a downtrend, what's neutral, choppy. This is going to differ, these definitions, based on your time frame, whether you're more of a swing trader, position trader. Even if you're a day trader, you want to define what a trend day looks like versus a distribution day, choppy day, all of that. So make sure you've got those definitions down. Then you can develop a market cycle count, just like Rai kind of showed an example of, and also, journal, plan out how you'll do that, whether you're noting down extensions, stress tests, and anticipations, thoughts about what the market should do, based on the recent action. What's my expectation? What would be an expectation breaker of that expectation? Everything's cyclical, so noting this down and having rules about journaling will definitely help you in the long run, because you'll get to connect, the current state to past states, things you've experienced before, and you'll have that data available to serve as a different reference.
And also, I saw quite a few people implement this, and if any of these concepts seem foreign to you, we went into the depths of it, including templates and everything in prior webinars. So, but it was good to see a lot of people implement this, and I think it will benefit you as you journal more and more. From one cycle to the next, you will see those patterns, because there are patterns that exist, and it's almost the same thing that just happens in a different time span. So.
Yeah, and my personal market cycle is pretty much defined or centered around kind of the 21 EMA, and it's incorporated a lot of Oliver Kell's methodology, which I think is a great one to kind of learn and start with. But we'll get into that in just a second. So 7 key steps building a market cycle. We went through each of these different steps in depth in that webinar. You want to choose your time frame. Are you a swing trader, day trader, position trader, investor? Your rules of what defines a market cycle will be very different. I mean, there's the long-term cycle defined more like Stan Weinstein's stage analysis, while a swing trader will have a much different system. Then you want to choose relevant indicators that relate and apply to that time frame. Start simple, go back, study historical market bottoms, market tops, corrections, all of that. How your rules that you've kind of started as your base iteration apply to that. Write down observations, and then from those observations, refine your market cycle rules. And then again, you'll constantly be iterating, picking up something new based on the new market feedback and market experience that you gain in real time. So again, just to stress, as I did during that webinar, keep it very simple to start with. Start with something as simple as when the market crosses above the rising 21 EMA, that starts your upcycle. It crosses below that 21 EMA, whether that's declining or not, you can decide for yourself. That starts the down cycle. Start from something as simple as that, and don't take into 20 different indicators into account until you kind of get to that point. Start simple, and then you can always build off that foundation.
Perfect.
And you know, we went through a few examples. This is Oliver Kell's market cycle, how he defines it. Definitely a super helpful methodology. And then on the next slide, we've also got John Boyk, how he does it with the new highs, new lows. He went back and studied, you know, what were these numbers looking like, you know, going back to the early 1900s. You know, and he learned this from a lot of legendary traders, historical traders, who also took a look at these different metrics. So again, whatever indicator or process you're using, go back, study it, and make sure it works for you, works for your style, all of that, and then create some awesome rules related to that.
And there's a really good book by Alexander Elder on new high, new lows. He wrote back in, I think, 2003 or something, where he called it the top, or the leading indicator of market trends. So that one's a good one. It's on Amazon. You can order it.
All right, so getting into kind of the screening and routines part of your rule set. Basically, you want to be able to kind of list out the steps that you're going to take during your weekly and daily trading routines. And this will incorporate, you know, market analysis of what's going on, analysis of your portfolio, how did you trade that week. Then it will, you know, incorporate also your screening process. What screens are you going to run? How are you going to go through them? Maybe if there's a different market environment, you're going to take a look at this screen, and then also should, you know, talk about how to take those screens and segment out the best of the best stocks to create that focus list, and how you're going to basically stay organized with all your different ideas. And at the end of the day, your routine should basically sum up to if this, then that, and you want to make sure you list out the kind of different logistical or preparation tasks that you're going to have to do once you've got these ideas, your focus list, all that set, such as, you know, putting alerts in, adjusting any stops you have in with your broker. You basically want to list out the different process that you're going to take here. So again, a trader of a similar level could take a look at your weekly trading routine, and they could pretty much complete it just as you would. This may feel a little bit tedious, but again, these trading routines and frameworks, all of that is designed to help you build a system that you can iterate off of and build that trading plan that you can use for the decades that you'll be trading. And
Yeah, so this is my weekend routine. So I do some scanning, right? Next, review my positions, go over some of the insights from the report that Ross puts together. Review the key watch list. So I have 3 key watch lists: the Gappers, IPO, HDF, and I've been doing this for more than 3.5, 4 years now. Like the same thing. I tweak it a little bit, add maybe, try new things, but then subtract it, etc. But the core of the routine is, these 3 watch lists give me what I need as whatever you want to call it, position trader, swing trader in the markets, to build positions, and get into names, be it leadership names or just pure swing trades, and then build a focus list from those 3 watch lists that I maintain. Make sure I have a tally of the number of edges each of the names has, and then according to that, I do my position sizing, prep, and then basically at that point, I think what's become a lot more important for me is the number 1 written here in the weekly plan, which is the emotional review, is a lot more important now than some of the mechanical stuff, because this is all mechanical, right? You go through, you run a scan, you find a name, you put it on your watch list. Then you collect the amount of edges on a per name basis, build your position. All of this stuff is mechanical, whereas emotional review is probably more performance based. Like how are you feeling that day? How are things outside of trading? Have you taken enough time off? Are you feeling burnt out, etc.? Becomes a lot more important after you get your mechanical things done. Second, market conditions, potential leadership groups. So I define very deliberately that, hey, this trend and this market cycle, what are the top stocks that are performing? Is it gold names? Is it uranium? Is it gold miners? Is it silver miners? Is it crypto, right? And those are just some of the recent examples or the other trends that we've seen in the markets. Then based on that, what happens is that, in the back of my mind, if I know my leadership groups for a fact based on relative strength, which is again one of the edges that we discussed, then I build off of that the focus list, which should be reflective of what's moving in the markets. And when I do that, I see a lot more success. So this weekly plan is a lot more deliberate into writing it's not about what I feel, right? I tend to gravitate towards, let's say, software technology names, because that's kind of the age that we've grown up in, right? But there are always other trends that show up, be it the oil and gas in 2022, uranium this year was an incredible trade to get into, and then recently crypto has been on the bounce. Some of the crypto names got going for a few there as well. So yeah, review your positions and then focus list for the next week and the next day. Usually I stick to the same universe, especially during earnings season. The gappers watch list gets updated quite a bit because we see new gappers pop up. This week we had NRDS as one of them that gapped and then just went for about, I think, an 18 to 20% run in 4 sessions. And there are many of those that are popping up as risk appetite increases in the market. New stocks are popping up as they report earnings surprises. There's some sort of rotation also happening. And these 3 watch lists kind of keep me in tune with that. So that's my weekend routine.
Yeah, this is a great framework to start off of. And then the next part in your rule set is, it might be very similar to weekly routine, just a little bit shorter, but you also want to kind of define what you'll do on a daily basis to, prepare for the trading day, trade actually during the day, and then, after the market closes, how are you journaling, screening, preparing for the next session, basically. And these are 7 steps that we went through, very in depth in that webinar. I think it was webinar 5 or 6, that kind of give you again a good starting point to create this for yourself. And here we'll fly through a few slides that we covered. Building your game plan for the day, from your focus list. What's your entry tactic, expected position sizing, your stop loss / risk level for each position. That you have. What are key levels that you're watching? Are there any position management actions that you'll likely take that day? If this, then that. Again, just kind of plan this out for yourself in advance.
And the most important here is, if you know the type of day it's going to be, write that down, because that's what I tend to do. Is I write down today. Okay, today is a risk management day, so I keep track of my existing positions, take a look at them, see how they're doing, and there's no need to act on new names in the markets, right? So that's one type of day. Another type of day is we're early in the cycle. We might get a trend reversal. We might get some sort of expectation that we're going from a negative to a positive cycle. So I'm going to be aggressive if that happens. If I'm going to be aggressive, what are some of the names on my focus list that I'm going to execute upon? Just defining those 2 will allow you to go into the session with some sort of deliberate plan. And most of the time, as you do that, day to day through your daily routine, you're going to get a lot better naturally, because one day you might say, hey, I need to be aggressive. You are aggressive. The market gives you feedback. You're down 2% on 3 of the positions that you put on. Well, now you can learn from that and make your plan better the next time around, right? So.
Yep. And then here's some more slides that we went through. Again, definitely check out the full webinar to go in depth into details, but this is what you should be thinking about 9:30, 10:45, or maybe you decide in your game plan you don't want to trade during this period and you prefer to trade, at near the close or something like that. Define in your trading rule set how you're gonna, act during the trading day. And this is just some examples of kind of what we look for, setting that game plan, watching price action, looking at volume run rate for different ideas, and then also looking for confirming action from other growth stocks in the same group, all that different stuff. And this is personally, kind of my process. I constantly inserting my watch list by percent change from the open, the closing range, the volume run rate. And this gives me a great sense of, what's moving off the open, what's moving today. And that's super helpful when deciding, what stocks from my focus list should I be most focused on to potentially enter.
Yeah, and usually what I tend to do is when the market opens, My focus is just I have my focus list open for the first at least 9:30 to 10:15. I need to, because that's kind of the execution part of it. If it's that type of day that we're going in, right? Then there might be after 10:15, I flip to the universe. Universe list has all the tickers from all of my watch lists in one list. And I'm usually just going through that again and again and again just to see how the market's doing. Are we seeing rotation? Are we seeing strength in one group and weakness in the other? Are we seeing weakness across the board, but the market's holding up because the big caps are holding up? And that list usually, as I go through it again and again, maybe once an hour, or it's more often early in the session. Then you step away, you come back, and then at the end of the day, review it again. Usually gives you a good idea of what happened that day.
Yeah, and then again, here's just a framework that you can start with as kind of an evening daily routine. What will you do after the close to make sure you're staying up to date with your positions as well as any ideas that are developing in the markets? And if it does feel like we're flying through that, remember we kind of already went through this, so um, we'll have links, in the description to the full playlist where we go into everything in depth. So now, talking specifically about screening, for me, there's kind of two different objectives here. One, it's a great way to get a feel for the market. You run a general screen, you run a specialist screen, you run through those different stocks, you look at their charts. Oh, you notice gold stocks are acting well. Oh, as a whole, everything lifted last week. Oh, everything's breaking moving averages together. All that, screening and looking through hundreds of stocks gives you a great view into the health of the market that surpasses, what the overall indexes are doing. So it helps build that overall situational awareness. And then, of course, the main objective that most people focus on is trade ideation, running screens to actually find stocks that you'll put on your focus list and then potentially enter as a trade. So just a quick thing on general screens versus special screens. General screens cast a wide net. They just kind of have minimum criteria. These are great for seeing how stocks and groups are developing, while specialist screens are a lot more focused. They have very strict criteria that maybe look for a particular instance, such as triple digit earnings growth last quarter with an earnings surprise of 50%. That will only show up, a handful of stocks. So it's a lot more focused. It's more like a scalpel versus the general screens are more like casting a wide net. This is kind of two main categories that I kind of think about putting screens into, and it can be helpful to both run general screens as well as specialist screens, but they kind of have, particular different use cases. For instance, specialist screens, there might be a specialist screen that you run specifically in a situation like right now where we've had a huge move off the bottom, and you want to see stocks that are setting up right now. You might have a whole specialist screen that you only use when this type of pattern occurs in the markets. So here's an example, the Deep View Universe screen. There's some minimum liquidity trend RS requirements here, but it typically outputs about 300 to 400 names. And it just gives you, again, a sense of, what overall groups are working and what stocks are shaping up together, versus the next slide. We've got a much more special screen called the Power 21, where it's very high RS, and then the stock must be within a few percent of the 21 EMA. And I actually just made another specialist screen yesterday because RMV is now a screenable criteria. So I've made a few kind of specialist screens looking for very tight ranges, because that's one of the entry tactics that I really like to employ. And it's awesome to be able to create a screen that looks for those tight areas, which are great for entries, as well as just being kind of a winning characteristic, constructive price and volume action. Rai, anything you want to add when it comes to screening, both general screens or specialist screens that you like to employ?
Yeah, some of the special ones that I run is the HDF, right? Review the IPOs. So IPOs over the past 3 years, and review the gap ups that happened. in the market. So those are my specialist screens because they go directly, those symbols that I see have potential go directly into the 3 key watch lists that I maintain. And then the general screens is the liquidity one, the DP universe, and up on volume that Ross tends to run. So those 3 are kind of my general screens. They give you an idea of rotation. They give you an idea of the health of the market, right? And if you're not seeing a lot of stocks on up on volume, it means that the market's not doing too well, etc. So those are some of the general versus specialist ones that I tend to run.
Yeah, and I saw a question just briefly about the screen on the previous slide. There's group 1 and 2 because 1 is an and group, which means every criteria in that group must be met, and then group 2, only one of those criteria must be met. So either the stock has performed well on a 1-month basis or on an overall 3-month basis. So it's just a special feature in DeepView that allows you to get a lot more specific with your screening. All right, so moving on to edges and entry setups. Again, I put this slide that Rai had in there again. Rai, do you want to walk through,
So what we want to think about for an edge is it's just nothing more than it gives you a higher probability of one outcome over the other, right? In our case, the outcome is a positive or a winning trade over another trade, right? So as we go in the markets as position and swing traders, we need to have some sort of edge that we want to make sure is we're deploying so that it's something that we've studied, is something that winners have exhibited, or stocks that you short, you want to go out and short have exhibited as well, right? So an edge doesn't have to be just long only; it could be short only, as long as you've done your homework on that, and it gives you over a span of many trades, let's say 20 trades, 30 trades, 100 trades, you're going to come out on top. And that's what an edge is. You need to have statistics, numbers, probabilities, and some sort of certainty at the end of the day that this edge, if you deploy it over a span of time, will result in a positive outcome. So what are some of the characteristics that we discussed throughout the series? Prior leadership stocks, if you're trying to build a bullish edge or a edge where you're betting that the stock is going to go up, right, from the point you purchase it, you probably want to look at what prior stocks have done, right? You want to hunt these characteristics in the market, execute upon them repeatedly. So if we execute our edge repeatedly, and the fact that an edge means that we're going to have a positive or whatever that positive outcome is for your trading at the end of that repeated execution, then obviously you're going to come out at the top. The most important part is they must be self-studied, right? So you can't go out, read a thread, and that's your edge. That is rarely going to work for you. And the last one that we have is you must go, yourself and do the deep dives into whatever it is that you pick. It could be as simple as moving average crossovers. It could be simple as MACD crossing above the 0 line, or it could be as simple as a 3-bar pattern that you look for in the markets, right? Maybe a stock being down 8 sessions in a row, and now that's your oversold setup that you play, right? It takes the high of the previous day after being down 8 sessions in a row, for example. Whatever it is, you have to go and really look into it yourself. Build model books that we've talked about, collect a whole bunch of examples. We've done all of that stuff throughout the previous webinars, and that's how you want to formulate your edge in the markets. After that, we spoke about, some setup. So the Launchpad setup is one of the things that, Ross uses quite often in his trading. I use quite often in my trading. We could scan for it as well. It's basically the 21-day, 50-day, and the 65 EMA being very bunched up or close together within 1 to 3% of each other. What that means is that the stock is based out over a span of 65 sessions. And 65 sessions in the market is usually 3+ months, right? And what we're looking at is some sort of tight consolidation, and the bunching of moving averages means that on these 3 time frames, the prices at this point has contracted quite a bit. And what we've seen based on this pattern or this setup is that stocks will get volatile to the upside or the downside. Some sort of directional movement will happen, right? Then you can analyze the base, you can analyze the market condition, look at your market cycle account, have a whole bunch of these. Usually you'll see a whole bunch of Launchpad setups as the market is coming out of correction. Up the right side is what some people can call it, right? Up the right side action. And when you see a bunch of these, the market's, prime and ready to go, and ready to switch direction from a downtrend to an uptrend. So the other one is the gapper setup that we've spoken about. So a gapper setup is basically a stock gaps up on news, earnings, catalyst, what have you. There's some sort of surprise that caught the market off guard. We have a gap up. Usually the good ones are the best ones based on the studies that I've done, have a closing range or a daily closing range of greater than 50% and also a weekly closing range of greater than 50%. Usually when you get a whole bunch of them in the same sector or the same industry group, that's a huge positive sign of a theme that's developing in the markets. Remember that 37% of a stock's move is based on industry, 12% is based on sector, and 3 out of 4 stocks move with the markets. Those 3 stats alone can contribute to a lot of the success that you see in the gapper setup. This year in 2023, May alone, we saw about, I would say, 10 to 12 types of these gappers in the markets that went up 60 to 80% from May to September. So it's a really good time frame to study and kind of log those ideas as well. And that's another setup that you could have in your playbook. These are just some of the examples, right? So just showcasing the fact that we have the highest volume in over a year. So I tend to break down what kind of volume are we seeing. Is it the highest volume ever, highest volume since IPO, highest volume in a year? And usually the highest volume since IPO tells you that the stock has gone through what, even it and their team, the IPO team, would call the due diligence phase, right? And now there's some sort of there's enough research that's happened and institutions are confident in the future or the story of this stock, and that's reflected with the highest volume since IPO. That one and the highest volume ever are usually the top 2 biggest catalysts that I've seen in some of the winners that we see in the markets. And these are just some of the examples. Market goes into an uptrend, we see a gap up in the markets. So 3 out of 4 stocks move with the market. These stocks move with the market. Richard, you could cover the up the right side.
Yeah, the up the right side is basically looking for consolidation pivots, and they're not full bases, but they're spots where you can manage risk effectively as a part of a larger setup. And taking a step back, again, we dove into examples and full explanations of the different setups in a previous webinar. The thing that you should think about when you're writing your trading rules is, what are the top 1 or 2 setups that you want to employ in the markets? What are the edges that you're going to look for? And you want to fully define them, ideally with a couple examples for each one in your rule set. And doing this is a tough exercise. It's hard to describe what exactly you're looking for, but it will clarify your thinking so you know even better what exactly you're looking for. We had to come up with a definition of the launching pad, which is basically something that Ross, saw in the markets over and over his experience. That's just a winning pattern that he noticed. But until we wrote it down, moving averages within a few percent of each other, it was tough to build a screen around that. It was tougher to explain it to different traders. So doing this process of defining your setups, the ones you're going to use, as well as your edges, again, it'll help clarify your thinking, and it's an excellent exercise to do that will help you improve as a trader. So with all these setups that we kind of use, again, we focus on pretty much each of us kind of 1 or 2, and then we focus on building intuition, studying that one, and becoming as good as we can at that particular setup. You don't need to have 10, 15 different setups to do well in the market. In fact, it's better to master 1 or 2 that appear again and again in the market. And so this is kind of exactly what I was talking about: specialization and simplification, mastery yield success. If you focus on the momentum aspect of the market and master it, your chances of success increases dramatically. Rai, I know you've been inspired a lot by Atomic Habits. It's a great thing to add, bit by bit, continuous improvement, all that stuff. And having fewer inputs and just simplifying it, focusing on 2 setups versus 15, it helps you focus and eliminate noise in the markets, which I'm sure every single one of us has experienced. You looking at social media, there's so many different ideas out there, so many different stocks to watch. But if you focus on just a select few things and focus really hard on your execution of your plan, it helps simplify everything and clarify what exactly you should be focused on at any given instant. All right, so the last layer, after you've got all that entry tactics, what are entry tactics? Rod, do you want to run through this?
Yeah, so entry tactics after you have an edge, right? You make an observation in the markets. Now, how do you enter those stocks and really get granular with your position sizing, where exactly you're going to make that move once you have an edge that you know is present visually on the charts. And it could be, a fundamental edge in the balance sheets, income sheets, cash flow statements, all of that, depending on what you specialize in, right? And then you have to plan for kind of how do you get in on the action, and that's basically what entry tactics are. For us as technical traders, entry tactics allow you to they have to allow you to manage risk. So if you say that if a stock moves below 5% below my entry point, I cannot, I have to sell it. Then your entry tactics have to align with that max loss or max stop loss rule, right? And that's essentially what they are. They allow you to position size and manage risk. As long as you remember those two things, then that's how you develop entries. Some traders use, downward trend lines, consolidation pivots, base pivots, pivot retest, undercut, and rally type of stuff. There's a lot of stuff, 3 days, 3 inside days in a row. I'll take the high of that based on the bigger pattern that I see or the bigger edge that I see on the charts. So anything that allows you to manage risk and position size up or according to your rule sets is basically what an entry tactic is. And you want to deploy a few different ways. You're not going to have a lot of these that are listed on the last bullet here on this slide. You won't have them in your toolbox right away, but over time you will develop some techniques that are unique to you. And some of the ones that I've developed, like the uppercut hold, the undercut hold. I tend to do a lot of whole number trading because that makes it easy for me to manage positions that you will develop as you go, through your journey. So start with a few very simple ones, right? Most traders, I would recommend, start with consolidation pivots, keep it simple. Yes, you can always be early. Yes, you can buy the low of every base. Those are very good goals to have, though unrealistic. But over time, you will get into stocks earlier and earlier as your anticipation gets better and better. That's not going to happen overnight or by reading a book. It will happen over a span of time as you start with consolidation pivots, very simple ones, and you consistently see success in those. That will, in the back of your mind, develop or help you to move those consolidation pivots lower. And maybe, some people use trend lines. Why do they do that? Because they've noticed that, a 3-touch trend line, declining trend line seems to work better or is an early entry to a consolidation pivot. And those things you will kind of add to your toolbox as you go from stage 1 to 2 to 3.
Yeah, looking at those, I would say I primarily use tight price action and volume dry up as well as consolidation pivot. You don't like the setups, you don't need that many.
Yeah.
I kind of gravitate more towards the buying on strength part of trading, that style, versus Rai is more, buying some weakness after strength. So it's going to be dependent on your style, but the key thing is, again, in your rule set, you want to define the entry tactics you use and exactly what they look like and where your entry point will be, where your stop loss will be set. Again, plan that out all ahead of time. So here are just some more entry tactics based on edges. You've got your high volume gap ups, and then you can use HVC, volume support, whole number support, and then with the RS edge, you can then focus on consolidation pivots or base pivots. The second bullet here is more kind of my style, while Rai, you kind of use both of these as well.
Yes.
Yep.
So This is kind of the same thing. So shorter term pattern in the context of overall setup, right? Uh, Again, two things allows you to manage risk, right? That's what an entry tactic is, and allows you to position size properly. Tight logical stop. So let's say you start here as your consolidation pivot, right? As a stage 1-2 trader, over time you'll notice an early entry area as well. And as you go, and develop more experience, more seat time, look at these patterns again and again, you will get better and better or earlier and earlier entries. This notion that you're always supposed to start here and you never should look at consolidation pivots will likely gets a lot of traders into trouble, because when you operate within an area and you're anticipating is a lot different than when you have some certainty with respect to the trend in the markets. So this one, it's pretty much the same thing. So context matters. So entry tactics should not be used in isolation. So if the market is below the 21 EMA on the Nasdaq and you're still deploying bullish setups, or your market cycle count is negative and you're still going out and placing bullish trades, that's 90% of you that are watching right now probably do that, right? That's one of the reasons we're stage 1 and 2 traders. We need to stop doing that and using things in isolation. Context of what we're in, the situation the market's in, the environment the market's in, where your market cycle count is and what's happening around it matters a lot more than trying to catch 1 out of the 10 names that's moving in the markets at the end of the day. So stack the odds in your favor. If you haven't taken anything from the last 10 webinars, again, 3 or 4 stocks move with the market, 37% of the stocks move with their industry group movement, at 12% with sector. Align yourself with that, and your chances of success, or you stacking your odds in your favor, will be a lot better. And you'll see that in your results.
So here's
more entry tactics, just different types: high volume close, hold number support, range breakout, undercut rally, oops reversal, and pullback support. These are just different ways of saying that I can manage my risk and I can position size when these instances happen in the overall context of each of these setups. So oops reversal is basically a stock opens below the prior day's low and reclaims it. And as soon as it reclaims it, the idea is that the momentum of that name will reverse in the opposite direction. And that could be an entry tactic you use to re-enter let's say a leadership name, or a stock that's doing the oops reversal plus undercut of the 21-day, for example, or testing the 21-day SMA for the first time. So these are just different ways for you to, once you identify an edge in the markets, you use these entry tactics to kind of enter into each of these names.
Yeah, and here's just, I want to include this again, some key questions to think about as you're kind of creating your rule set for a buying checklist. These are questions that you can write down that you can ask yourself in the moment, that are just a good way of making sure that you can manage your risk and you're entering at a proper point. So definitely check these out on your own time. All right, so getting into risk management, again, tight and logical stop loss. I think this is one of the most important concepts that we've talked about throughout these 10 webinars. This is something that Ross emphasizes so much. Both the entry point and stop loss must be set in a way that you have both a tight and logical stop where your risk is managed. Tight basically means that it's within a few percent, allowing you to position size well. A logical means that it makes sense for the entry tactic or setup that you're using, meaning that if the stock reverses, hits your stop, it's at a logical point, which tells you that the setup and entry tactic has failed. So combining these two will make sure that you're buying at a point where you can position size enough that it will move the needle, but you're also managing your downside at the same point. If you're buying out of nowhere when the stock's already extended, you can't place a tight and logical stop loss. So you should wait for the next proper entry point. And this is just one of my favorite quotes, so I want to say it again. The tape does not concern itself with the why and wherefore. The reason for what a certain stock does today may not be known for 2 or 3 days or weeks or months, but what the dickens does that matter? Your business with the tape is now, not tomorrow, from Jesse Livermore. So the key thing is here, we manage risk in real time. we act based on the information we're given at the point, at that point, at that time, and do the best we can and make sure that we're managing risk. This past week we've had a power move off the lows. Not many people expected that, and the reason why we did that is maybe a little bit unclear. Obviously, there's catalysts, but that was the market's reaction, and that's the truth in this moment. So manage risk in real time, act in real time, take into account what's going on and not what you hope will occur later on in the future. And then a lot of people like this analogy, so I wanted to mention it again. Your stop loss, think about it as if you're buying a ticket that allows you to enter that trade. Think of that money as almost gone. That's kind of the accepted capital that you're willing to spend to potentially ride that trade as a winner. Maybe you're able to move up your stop later on and lower that ticket amount that you paid. But if you think about it this way, you've kind of already accepted the loss, and that allows you to give the stock a lot more of a chance instead of, it's declining 0.5% for my entry. Should I get out? Should I get out now? No, your stop loss is 3% below. That's where the setup would fail. Give it time and, just see if your ticket pays off.
Perfect.
So position sizing, we went through some different guidelines, and I think on the next few slides we've run through again some guidelines for stage 1, stage 2, and stage 3 traders. And Rai, I'll hand over this to you.
Yeah, some of the basic rules that you want to keep in mind is stage 1 traders, align yourself again with position size, with market position size, with how your previous couple of trades are going. So let's say your last 5 trades are losers, you should be sizing down more and more and more until you hit a winner, right? And in that position sizing webinar, we covered that quite a bit with visual examples as well. Stage 2 traders, you figured something out in the markets that you're moving up when the market's good, but you're giving it back because you're not switching your stance quick enough, and you give back all those gains when the market gets bad. Because most importantly, the reason is, again, you're not aligning yourself with the market, and you're not you don't taste the winners long enough, so that you're just in this boom bust kind of cycle back and forth. So position size, there's a few ways you could do it. One is with how your previous trades are doing. I think that's very important. The second is the number of edges that you have on that particular chart can play a big role. Let's say a stock gaps up, it's in a potential leadership group, it's exhibited relative strength, and it's the highest volume ever. Now, those 3 things, when they align, are a powerful combination. Usually that results in that stock moving with the market and being a big winner in the market. So on those names, you can position size a lot more relatively to a name that might only have 1 out of those 4 edges present. So that's another way that you could go about it. Another thing is, I think that's super important is, this is not about who has the biggest balls. This is not about who has the biggest ego. This is not about who can double their money the quickest and put on wacky position sizes, right? 30, 35% as stage 1 and 2 traders. We want to make sure that we develop the proper experience, the proper frameworks. We do the homework on those frameworks over a span of 5 to 7 years and personalize each of those frameworks to ourselves, so that we can be in a position to go out and position size 20 to 25% or 30% on a single position. Almost never, I would say, even for stage 3 traders, never position size above 50% or half of your account at once, because there's no certainties that exist in the markets, and you could likely blow up a lot of progress that you've made over a span of 1 to 3 years just by making a stupid decision or a stupid bet that you think that there's almost a certainty that this thing has to go up. There's no such thing like that in the markets. So covered this. So max loss 5%, number of positions less than 10, max position size 8 to 10%. Usually a good spot to start out. You're developing a feel for the market. Have your journey, have a perspective on your journey that you're going to go through. You're all going to start as stage 1 and 2, or you're already in stage 1 and 2, there's no need to go out and position size more, heighten your emotion, and then when you're losing money, turn into an investor from a swing trader to an investor in a particular name. Stage 2 traders, you can position size up a little bit, 12 to 15. Again, this is mostly based on your emotional control and how you feel when you're losing money in the markets. Are you okay, or have you accepted that ticket? You know, what Richard's analogy was that's a ticket. You have to accept that loss, and it's almost like if that money's gone, you'll be completely fine, right? And when you can operate in that kind of headspace, your decision making will be a lot better. And that's usually stage 2 traders have matured enough to kind of move up a little bit. Stage 3 traders, even some of them I know will not take 20% position size. It's not even close. They will stick to 10 to 12 to 15% because that's the way they emotionally operate, or they have an emotional balance when it comes to managing their positions as well. Something you'll notice is the max loss I would recommend should always be closer to 5%, regardless, because again, if you have an edge, you have a market cycle that you're trying to time the market with at the end of the day, and you're aligning with what the market's doing. If a name is down more than 5% at that point, that usually means you need to get out of the way because your edge is not working or it's not present at that point in time. So those are some of the position sizing. We've done a whole webinar based on that, and we go into depth on how you could journal it, how you could visualize it, how you could see it, and then how you could deploy each of these as stage 1, 2, and 3 traders.
Yeah, so getting into the next section of your rules and the next webinar that we went over, sell rules and position management, it's not as sexy as entry tactics and setups, but it's so important to allow you to stretch your gains and also protect yourself when the trend really changes. So whatever your time frame is, whether you're a swing trader or a position trader, you're going to want to capture the trend, the relevant trend for your time frame. So swing traders like to operate during that momentum move, maybe on the further end, the longer end, they're operating kind of base to base. That's kind of what I'm shooting for, while position traders might want to get in earlier on in the trend and then look to hold as the stock trends above the 50-day, the 200-day moving average. So think about your time frame when you're writing these rules, these position management rules, and pick the relevant indicator, time span, all that that makes sense for your character as well as your style. The key thing is you want to let the stock work for you. You want to give it the benefit of the doubt, especially in a strong market. And then in a choppy market, like we saw in 2022, I think, Rai, I think you did as well. We all kind of shortened up our time frame a little bit, took profits a little bit earlier, moved our stops to break even faster, all of that to adapt to that different environment. So think about different situations, different type of markets, and that how that might impact your position management rules as well. And this is a good quote from Jesse Livermore. It was never my thinking that made the big money for me. It was always sitting tight. One of the most helpful things that anybody can learn is to give up trying to catch the last eighth or the first. These are the two most expensive eights in the world. And what he's saying there is basically he's looking to enter after the trend is getting underway. It's already being accumulated. There's signs that the trend is changing. And then he wants to get out, during this, after the stock has made the strongest part of its advance. He's not trying to be greedy and capture everything and get out at the last, the highest tick ever. He wants to capture that meat, that six of the ace in between there. So when you're writing your trading rules, think about that. You want to try to capture that relevant part of the trend for your time frame.
This is a really good one because a lot of traders are fascinated by the fact that certain people out there can catch the bottom and the top of everything, where it's really not about that bottom and top. And that's one of the key takeaways from the stage analysis masterclass as well with Stan, where he's waiting for that stage 1 to build out and trigger into stage 2, because that's when he feels he has the biggest edge on the long side in the market. So he's not timing the bottom of any base. Same thing with William O'Neill. He would track the whole base, track its potential, and then when it broke out, he would then act upon that. So this fascination of the first, eighth, and the bottom and the top, essentially, a lot of stage 1, 2 traders um, go through that phase where they want some indicator, they want some perfect Fibonacci or some pivot, floor pivot to give them that to the T, right? To the penny, to the dollar. And none of that is really important when it comes to swing trading and position trading.
Yeah, I saw a question about the max stop losses from the previous section. 5%, it's on a per position basis. So that's not your equity. You should keep your equity losses ideally less than 1%. I like to shoot for 0.75% max. It depends on the position size again and where your stop is at. O'Neill, he says in his book 8%, but that's kind of in the most ideal scenario where the stock meets every single criteria. It's moving from its first base, and I know multiple people who kind of worked with him, whatever, that his average loss, he wanted that to be a lot less than 8%. So and not all of us are William O'Neill, where he had a special eye for identifying huge leaders, meaning his average gain was a lot bigger than typical, and his batting average was higher than typical. So you have to operate within what your performance dictates. You shouldn't just say O'Neill did 8% stops, so I'm going to do 8% stops. If your average gain is only 6% and your average loss is 8%, because you always set that because that's what O'Neill did, so that's what you're going to do, you're not going to succeed in the market. So you got to figure out what works for you, not just what worked for somebody else who
And
who has completely different skill set than you. Yeah.
that 8% is based on the fact that when they did the 60 to 80-year study and classified leadership stocks that broke out from base pivots, and every single word I'm saying right now is important because it's a base that's formed out. They analyzed those pivots and they said most leadership stocks tend to pull back no more than 8%, right? So that stop loss that O'Neill recommends is what it's saying is if you buy at a base that I've defined, and if you buy properly, that stock should not pull back more than 8% if it's a leader. That's all that stat is saying. He's not recommending 8% stop loss on your swing trades. That's ridiculous. That's a whole different thing. So reading something and what you understand from it and applying it to a different time frame doesn't work in trading. That's just how it is. That 8%, it came from a study that was done, and that's why they say 8%, 8%, 8%. It was not just like out of thin air. He said, hey, I feel good with losing 8% on a position. It was really with a study that they did. They classified them. They looked at the depth of the pullbacks after they broke out, and then they came up with that number. So that's just a little bit of color on the 8%.
Yeah. So getting more into the sell rules now, there's kind of two sides to it that you should define in your rule set. Selling into strength as the stock is moving up, and selling into weakness as the stock is breaking the trend for your time frame. So again, depending if you're a position trader, you might only sell into weakness. If you're a swing trader, you might only sell to strength. So or you might take a hybrid approach. So you have to define for yourself in your rule set which one you're going to focus on and how you will do each of them. So we talked about selling into strength in that previous webinar. You can sell 1/3 as a stock gets extended from a moving average. You can eyeball it. You can have a percentage, distance from a moving average, an ATR move, or it can be more of a feel if you're a stage 3 trader, late stage 2, where it feels too easy. That's what Dr. Wish says sometimes when he sells into strength, because it feels too easy. But he's basing that on 5 decades of trading. So it's good to have an objective number, especially to start with. And also just, selling at your average gain, or locking in profits in choppier markets earlier at 5% gain, at 10% gain, just to make sure you're paying for the paper cuts is a helpful tactic. So you got to define this for yourself. Ryan, anything you want to add on selling into strength? Because you're excellent at this.
Yeah, no, I think what I tend to do is correlate it with early in the cycle, late in the cycle type of movement. So if something like a Tesla happens back in 2020, 2021, it did, big extensions off the 10-day, something I picked up from Oliver Kell's masterclass. He's big on that. If it's extended from the 10-day and the 10-week, he tends to use that as something to sell into to strength as well. So for me, it's very market cycle dependent, right? And the last point is probably the most accurate. When it feels too easy, just I tend to um, sell. Maybe there's no reason for it, but just to guarantee that I'll have a higher equity curve at the end of this cycle, right? At the very least. For me, that gives me a lot of confidence, and it gives me a lot of peace of mind when I can guarantee. Not there's obviously no guarantees I could get caught with a gap down, but there's a lot more certainty that at the end of this cycle, I will have some money that I've made if things go according to plan. So that's how I think. If I improve my worst case scenario, as Mark Minervini would say, he's focused on his worst case, and if he can improve that as he's making progress, that's a lot better than thinking of how am I going to spend this money? What am I going to do with this money? That type of mindset.
Yep. And selling into weakness is more about trying to capture more of the trends, but you're going to have a drawdown at the end as the stock breaks off highs. So you can define this based on moving averages, higher lows, two closes below a moving average below the 21 EMA. Raya, I think I learned that from you, and that's an excellent way of defining when you're going to sell that last bit. And in strong uptrends, I think this is key. Try to wait and give it the benefit of the doubt until the end of the day, but you want to write that down in your rule set. Are you going to wait until the end of the day, or as it's breaking intraday, are you going to sell? Be that specific. So these are just some ideas that you can incorporate into your process. So those two different methods, selling into strength, selling into weakness, there's pros and cons to both of them. And depending on your style, again, you're going to lean more towards liking one or the other. If you're somebody who just kind of turns over their edge a lot, they're more of a swing trader. You're just looking to keep your equity curve near highs, your confidence near highs, but you're going to give up, the big moves that go on for 2 years that go up 1,000%, 500%, whatever it is. While if you're more in the selling to weakness camp, you're going to maybe round trip a little bit more or give back more off the top and have more drawdowns, but you're going to be able to capture those longer term trends that can really compound your account. But it might hurt your mental capital a little bit more. So it's a trade-off. You kind of have to decide what's better for your situation. All right. And then also, I think we mentioned this in the webinar, it's good to have total portfolio drawdown rules. If your equity curve is 5% off highs, what are you going to do? We had some guidelines here. You can have.
This is not negotiable. This is one of those non-negotiable rules. Like everybody should have this, especially stage 1, 2. You will stop. You'll get so much better just overnight, I think, when you do this.
The market can change really quick, especially if you're fully invested in growth stocks. They don't just break one by one; they break all of them at in the same day. This can happen in one day. So especially if you're on margin, which you should have rules about, by the way. We don't talk about that too much, but stage 1, 2 traders, I would say avoid margin pretty much. That's just a good guideline. You have to earn the right to use margin. Show that you can perform over multiple market cycles, then maybe you can decide to add some leverage. But yeah, these are great rules to incorporate, and this should be a section of your trading rules. All right, so getting into miscellaneous and emergency rules, trading around earnings, you should decide and identify, how are you going to handle earnings based on your profit cushion, based on the quality of the stock, because no matter what you think, this is a binary event where a stock can report seemingly good numbers and the market can drop it 20%. So for stage 1, 2 traders, the guideline is if your profit cushion is less than the implied move, sell it all before earnings. Later on, you can get fancier, sell portions, whatever. But if you don't have a profit cushion, it's a gamble at the end of the day, and a gamble that might pay off, but it might really set you back quite a bit.
Yeah, one of the rules with earnings is, one that I learned early on was if you're not up 10% at the very minimum, right? Stocks on average, they're especially growth stocks on average tend to have some volatility. And 10% is usually a good spot to be at if you want to trade, earnings or hold through earnings. What you don't want to do is, and I've done this myself, is be up, 2%, 3%, and kind of you're gambling at that point. If you want to do that and it drives your adrenaline or whatever the case might be, sell a portion of it and just keep maybe a seven, 1/7 or 1/6 or 1/5 of that position just to see. And you'll learn the hard way one of these trades, and then you'll go back to being, it's not about, getting a kick out of the market and seeing something up, or when it works, it's it's awesome and you're up 30% all of a sudden, and it's gapped up into this new area that where the stock's never traded before. But when it gaps down is when it hurts the most, right? And you're setting yourself back, and you're giving back a lot of money for no reason. So
Yep. The next one to think about is how will you handle if you lose internet? Ryan, I don't know if you have any stories about this, but I haven't had any bad stories, but I've had to turn on my hotspot, um, or run to a Starbucks or something. But think about in advance, so in the moment you're not panicked when you're 100% invested. Stocks are gapping down, and then suddenly, Xfinity decides to do some work or whatever. So have a plan, have a plan in place. Hotspot's an easy thing to use, or just know where the nearest Whole Foods or Starbucks or where you can get public Wi-Fi is that you can quickly run to with a laptop to make sure that you can trade effectively.
and also some stops would help, right? A lot of these events in the markets that tend to be talked about or written in history, what happens is there's a lot of money flowing out of the markets at once. So what they call flash crash or whatever you want to label them. And in that instance, what tends to happen is brokers can't handle the traffic, right? And you won't be able to sign in to any of them. So it's usually a good rule to have some basic stop losses in place for your positions at the end of the day. Even if you lose internet or you experience one of these 1987 type of situations, or even with technology and stuff, a lot of the electronic trading, right? Just to safeguard yourself, I think, having some basic stops with every order is a good practice. Unless you're at the desk all day, every day, which I know 90% of you, 95% of you aren't, then, having that basic stop loss will save you as well.
Yep. And then large gap downs, we talked about this. This is something that everybody will experience probably at some point. If you haven't yet, definitely have a plan for it. How will you know if this happens? Or will you sell right away in post market? Will you try to sell in the open, sell in the close, sell a partial at the open, wait to see what the trend of the day is, all that stuff. Have a plan either way. Personally, I'm more of a sell in post market, sell on the open type of person. I just want to have that clarity of not having that huge position or whether the position moving against me, and then I can always re-enter if it presents a good risk-free scenario. And these are kind of large gap downs. This isn't just the 3% gap down, 5% gap down on some type of normal news or maybe even offering. This is where there's some significant fundamental catalyst that occurs that's completely changing the story of a stock. And CRDO is kind of an example from previously this year.
And when you set your stops, you probably want to have like the extended markets on, right? So, and many of the brokers don't tend to turn that on by default. You have to go into the advanced settings and say, okay, my stop is also applicable when the market closes. So for me, how I've handled these is, one, if you know your position size and if you know your numbers, you are not that emotional about it. Many people don't know those first two things. That's why they don't know how much money they've lost. They don't know how much progress they've given away. They don't know their position sizing on that name because they don't believe that's an important aspect. those things matter when these things happen. So it's like, okay, I had a 4+5 R trade and I'm giving -7 Rs away on this gap down. Okay, I'm now down 2 Rs. Not that bad at the end of the day. That's a positive reaction to a negative thing that happened to you in the markets. And being the fact that, this is all about performance, that helps you at the end of the day. The next day is going to be a lot better than, on the scramble trying to find out what the heck happened. If you're in that situation and you don't have a position, that it's probably pretty bad already. So.
All right, so getting into journaling and that side of thing and the rules around that, we covered this in a previous webinar, but these are key parts that you should think about. I don't think we have to go too much on this slide here. This is kind of 7 steps to incorporate. Next, Rai. We also have post-analysis. In your rule set, you should talk about how often you're going to do post-analysis, what's going to be your process for doing so, how are you calculating or keeping your trade log, calculating key metrics, adjusting your trading rules based on post-analysis, all that stuff. This is really critical because, again, we've talked about this being a living document and iterating over it. And if you don't do post-analysis, you don't quite know what to iterate or what to improve. So this is a key part of having a feedback loop that improves your trading rules over time and your trading system and performance as a whole. And then we ran through the slides last time, but these are some questions to ask yourself during post-analysis. What was your plan? What were your edges? What was the market like? How did you handle the trade? Did you follow your plan? What key takeaways do you have? And how could you improve on your process going into the future? Some more conclusions here. What were your strengths? What were your weaknesses? What changes can you make, rule changes that will improve your system over time? Again, how often? Yeah, go ahead.
Yeah, this one is key. I mean, stage 1, you should do it as often as possible because you're losing money and your actions are not working. So you need to fix something. And the best way to fix, like a leaky bucket is to look at that bucket and why is it leaking, right? So if you're placing 10 trades a week and you lost money and you're stage 1 and you're constantly giving back money, you need to stop maybe trading and actually look at why you're trading those particular, 10 trades that caused you to lose them. So stage 1, the frequency has to be very high. The more you look at it, the more you're deliberate about it, the more you update your rules, your routines, the type of trader you are, where you operate in the markets, the faster you'll move to stage 2. Stage 2, you can do it monthly. It's perfectly fine. Where you look at it from month to month, right? You make money and then you lose it. Magnify the times that you are making money. Why are you making money in those time spans? Usually it's related to a positive market, increase in breadth, positive market cycle count, right? Early in the cycle when you trade, you see a lot of progress. And then later on in the cycle, you're placing equal position sizes and giving back whatever it is that you made because you now, you haven't figured out the other side where you should slow down a little bit when you get later on into the market cycle. Stage 3 can almost be mental, yearly, quarterly. I know stage 3 traders that don't do it at all, but they have a mental picture of when they need to step away. But then I also know stage 3 traders that do it quarterly, and they will, spend every 3 months, they will spend a full weekend, about 8 hours a day trying to get through what they did, how much they made, what's going on, what are things they could get better at over the next quarter, and kind of give themselves kind of a report card. And I know Richard has a template on like a yearly report card that you could grade yourself on. But very important for stage 1 to increase frequency, look at what you're doing wrong, look at why you're losing money is more important than going out and trying something new, and then continuously, continue to give money back to the markets.
Yeah, and then
this one's about, go ahead.
Well, I was going to say, I mean, after you've done all that post-analysis work, you want to make sure that you're adapting your trading rules based on that over time. You're not changing things because this week this rule didn't work, so you're going to throw it out and try something new. Over time, you'll notice trends that you do, things that you do on a repetitive basis that you can improve on, that will increase your edge over time. So focus on continuous improvement, treating trading as a journey, This will be something that you're doing for decades. So, have that mindset going into it. And especially for stage 1, 2 traders, focus on the risk management rules to begin with. How can you decrease your average loss, cap those max losses to 5%, and try to ride those trends a little bit longer? All right. So we're going to get into some further resources and then also jump into the Q&A. So first things first, we'll be working, we're currently working pretty hard on the Ultimate Trading Guide Pro version, which will essentially be like a trading undergraduate degree. It will incorporate a lot of the resources that we've talked about, get into more depth, more examples, specific frameworks and trading rule sets, and just provide a lot more resources and structure to a trader who's just starting out. So our goal here is to really accelerate people's learning curves, and they take this class and they'll be immediately propelled into stage 2 and have a good jump start and towards getting towards stage 3 and start, thinking about things the right way. So we're adding additional webinar resources to this, material that we haven't shared publicly. And this will be a really fantastic resource that I'm really excited about releasing, that I think will help out a lot of people, get a jump start and really get going. Rai, anything you want to add about Ultimate Trading Guide Pro, which this will be out within the next few weeks, I believe?
Yeah, so UTG Pro is just, all these webinars, we're kind of going to take it to that next level in terms of application, in terms of formalizing a lot of what we spoke about, giving you more step-by-step kind of, guideline, so that as you go through and do the lessons, topics, quizzes, worksheets, etc., it will walk you through each of the frameworks in a more one-on-one kind of a deliberate manner. So that's kind of the idea behind Ultimate Trading Guide Pro.
Yeah, so keep a lookout for that. Additionally, moving forward, we have the really fantastic Swing Trade Masterclass with Oliver Kell. Oliver, as I'm sure many of you know, was the US Investing Champion of 2020. He was also the record holder, 941%. And he shares his full system in this masterclass, really going into in depth with examples, how he screens the markets, how he manages risks, how he positions sizes. So once you develop your own system, if you really want to improve it, especially if you're a swing trader, I think that's who this is best for. Take this class and you'll realize, all the different improvements that you can make, because Oliver has gone through the same process. He's created a system and then iterated it, studied, built databases of model books, all that stuff, and improved his performance. So it's a really fantastic resource, sped up my learning curve quite a bit. And we've got a special code for everybody watching here, UTG savings. If you input that, you'll save an additional amounts off this masterclass. So Oliver really put his heart and soul into this, and it really shows, and he truly cares about you learning his system, learning his market cycle system. Just that in itself, the first webinar, really will help a lot of people stay in tune with what the market is doing. Next, we've got the Stan Weinstein Stage Analysis Masterclass. I think this is more perfect for active investors and position traders. Those swing traders can take it as well and get a lot out of it. Stan Weinstein, he's a legend. He's been doing this for decades, and this is basically the most in-depth he's ever explained his system. It adds a lot of new material to the book, how he's kind of adapted to the current faster environments. And there's also an amazing case study of his institutional letters from prior this year, where he walks through his weekend analysis and daily briefs of what's going on in the market. So you can basically learn exactly how he views the market through this class. And there's additional interviews with him that I did, Rai as well, and a great Q&A with him as well, where he walks through charts and explains exactly what he looks for. So really fantastic resource. It was a real pleasure to get to work with him. I never thought when I started, learning how to trade and I first read his book that I'd ever get to meet him, let alone, learn one-on-one with him. So this is a really great resource. Rai, you were a key part of this as well. Anything you want to add about this Stage Analysis Masterclass?
It just gives you a very updated with current, his book that he wrote was back in like 1970s, with the initial book, and then this is kind of like the revision to that book. Like, how does he see the markets today? How they have changed? What is he doing from a routines perspective? What he sees as how does he position into a name? How does he scan the markets, etc. So this covers all of that kind of from an updated perspective.
Yeah, I really liked the part where he talked about like all the stuff he does health wise to make sure his system is sustainable. I think that's something that a lot of traders don't really talk about. Next, we've got the historical analysis masterclass with John Boyd. This is the most recent one we did. This was really, really great. So John is the market historian. He's studied the greatest traders of all time. He's also studied the greatest stocks and market cycles going back over 100 years. And this class condenses all that information and presents it in a really logical and organized way that will basically speed up your learning curve. It will help you train your eyes to what to look for when it comes to the leading stocks. He shares a lot of key insights from these traders, key quotes, their process, their trading rules as well. He dives into that. And not only do we get to talk or analyze a lot of the legends, Jesse Livermore, William O'Neill, all of them. We had over 8 guest appearances from Oliver Kell, Matt Caruso's in this, Jim Ropel is in there multiple times. Eve did an excellent case study. So these top traders also joined in, shared their work, shared their process, their rules, their favorite entry tactics, all of that. So it really grew into a lot more than we originally thought it was going to be. And it's just a really good resource to help speed up your learning curve. Then, of course, we've got the IPO Masterclass for top-notch, money managers, share their work. And I think this is great for people who are building their first rule set because they dive a lot into the different sell rule systems that they developed after studying IPOs and super growth stocks. So this is a really excellent masterclass. 4 of the different webinars are dedicated to each one of these traders' individual styles and systems. So you get their entry tactics, their sell rules, stuff that can really help you in developing your own. And they all really worked extremely hard and are all experienced presenters and educators.
Yeah, and this is all about IPOs. Like they went in, they did studies, they have statistics, they know, developed patterns that they see in the successful, IPOs. And with IPOs being, one of the it's the best, in markets that are about to turn from a downtrend to an uptrend, usually IPOs. There are a couple of those names that lead the market and kind of double and triple quite a bit. So this is all about IPOs.
Yep. And lastly, this is a very different but also very important webinar series that we did with Jared Tendler, the author of The Mental Game of Trading. And he is a top-notch teacher. I tried to learn a lot from him when he was teaching this. But basically, what's different about Jared than I think other people who talk about trading psychology is he's developed a system, a process, a step-by-step system based on working with thousands of traders and other performance athletes and other performance, based people. He worked with a lot of golfers as well. That's kind of his background. He developed a system that's kind of step by step into mapping your emotions, diving deeper into them, finding the root of any mental game issues that you have, and how to solve them and kind of inject logic in real time into different emotions so they don't negatively impact you when you're trading. So it's an excellent system. He talks about the theory behind it as well. And he's a fantastic speaker and presenter and coach as well. So this was really special. And we talk a lot about entry setups and tactics and all that, but if your mind isn't right, none of that is going to matter or make sense. So Ryan, anything you want to add about the trading psychology masterclass with Jared?
Yeah, this becomes probably after you've done all the mechanical work with the frameworks, this is probably the most important for me in terms of what impacts your performance at the end of the day. Like if you know what type of stocks you're looking for, what your routine is, right? You've gone through the 9, 10 frameworks we spoke about, then this is kind of the next thing. The most toughest, thing in the market is to master. So
Yeah, I'd say for more stage two traders who want to take that next step to stage three, that master class is really important. So of course, the recommended tool is DeepView. We're working really hard to make this the ideal trading assistant for everybody. We're well on our way to accomplish that goal. We've got quite a bit of folks here and are growing every single month. Really exciting, and we've got some great new features coming in, such as dashboard coming up pretty soon, where you'll really be able
this
to
month.
customize your layout. Ryan, anything you want to mention with DeepView to really
Yeah,
emphasize?
I mean, so the next, I guess the two biggest features are dashboard is going to be rolled out sometime this month, which is basically, you can have multiple screeners, watch lists, charts, all on the same page, right? And then after that, the iOS and Android apps for Deep View. So using Deep View on the go has been requested a lot. So those are two of the top or the biggest things that we're working on into the end of the year. And then also we're going to have a slew of, economic calendars, earnings calendars, widgets that we incorporate in terms of data coming into the platform. Now that we have a pretty good screener and deep list modules already in the platform. So
Yeah, if you're a can slim type trader or a momentum type trader, there's no better tool out there to match this style. We've got the institutional quality estimates. The screener takes into account both fundamentals and technicals to a level that you haven't seen before, and it's a really fantastic program that's our daily drivers every single day, and we're working hard to make it better as well every single day. And also support you guys. If you're switching from another platform and are worried about, I won't be able to recreate my routines, or I won't know how to find some things, we have so many dedicated tutorials helping people get used to screeners. And every single week, I host a presentation on a particular aspect of DeepView, whether that's the screener or managing alerts or analyzing fundamentals. And I'll also answer all your general questions as well live. So we really built in a lot of support out there. So if you are transitioning from a platform that you're used to, you can really make the most out of DeepView. I recognize a lot of people who are attending today who have been part of those webinars, and it seems like it's really helping. So definitely recommend DeepView, deepview.com to sign up. Yeah, it's really exciting, and really looking forward to seeing how it grows from this point. All right, and then one last message, make sure you download the free Ultimate Trading Guide if you haven't already. I'll drop the link in just a second, but I think at this point we can transition to answering a lot of questions. So Rai, why don't you start and find a question while I drop that link in there?
yes. Finally, these webinars, best guidance I've experienced in 25 years. Awesome. Really good to hear that. Find some questions. Stop loss for investor initial entry, what should it be? So we can give you a number in terms of exactly what your stop loss should be. But what we've spoken about throughout this webinar is whatever allows you to hold that name and you're comfortable with that loss is what your stop loss is at the end of the day. Some general frameworks for investors, again, it depends on your entry tactic, what type of setup you're using to enter that. But as stage 1, 2, that 5% range is more than enough as even a position or a swing trader in the markets. Start there, and if you're comfortable or you want to trade on quarterly charts or monthly charts or weekly charts, then you could widen that stop loss by reducing your position size or open risk on a per position basis as well. So those are two ways you could go about it. In the screening session, there were combinations of criteria. It was not clear how they were combined. Combinations of criteria. That one's a little bit hard to answer, but I'm thinking it has to do with the group 1 and 2. So basically, group 1 in DeepView is all the conditions that need to be met for the name to pass through, and group 2 is all the conditional, if the first parameter or the second or the third is true, that's what group two is, are valid, then the whole group is also going to be true. I don't know if I explained that all too well, but that's how you kind of combine the different criteria.
The first group, every single one of those criteria needs to be true for a stock to pass through that layer. And then once you get to the second layer, only one of those conditions in that group needs to be true for the stock to successfully pass through. So you could put in the second group earnings growth or sales growth over 25%. And if it just meets one of those, if the stock meets one of those, then it'll pass through. All right. There's a good question, Rai, that I think you're the perfect person for this. Any recommendations for or advice to trade better from a cell phone?
Yes, switch to IBKR. That would be the first thing. I think they
We're not
have a
sponsored or anything. We're just
not sponsored yet. We don't get any kickback from that, but I use IBKR. So I'll tell you what I do. I use IBKR. I still have my focus list up on the screen, but my execution and my trades are all within that. Something you could do if the cell phone is the only thing you could look at. Again, the IBKR has a watch list. Put in your focus list, on a nightly basis there, and then at the open, just watch that focus list if that's the only way you could trade. But they have a really good app on mobile. So.
Yeah, and just talking generally about, trading while working full time. I had to do that for a year when I was working at the Naval Research Lab, right? You've experienced that as well. Just some guidance there. I would say do as much of your work as possible. Your routines become even more critical. Create your plan, well before you'll have to execute, and really make use of alerts. If you're able to, look at it for a quick second and place a trade, make sure you've got alerts in that will notify you. But if you're working full time, it's not necessarily it doesn't necessarily hurt you because it allows you to be almost a little bit more objective with price action, have a clear level in mind, and then just act on it. You're not so worried with the intraday price action, which might shake you out of a stock that turns out to be a great winner. So plan ahead of time, set alerts, consider trading from your phone. But Rai, any other advice for people who are working full time so they can succeed?
I would say just more offline work, right? The harder you work when the market's closed, and you can come to a desktop or like a MacBook and do your routines, and then have them stashed away, in IBKR or whatever app you choose, the better. Another thing is alerts are super helpful for those, type of people. So let's say you have a pivot at 25, that's where you're interested, set it at 24.50, so you can start tracking the name over a half hour as it kind of makes its way to 25. So your decision making window is not, it crosses a pivot, you have to make a decision. As you set an early alert, you track that name or you build that position into that name very slowly. And we I think for one of the webinars spent quite a bit of time, different ways to talk about how full-time folks can approach the markets.
All right, let's see here.
Need better buy rules. So I need better buy rules for V conditions, fast drop and fast rise. I think that you're taking the last week and saying the market trades like that all the time. That's not the case. It's just that this past week we saw some, good movement up from oversold conditions that was expected. Now I think it's more about how we trade over the next week and a half after this initial rally, right? Things have kind of been slapped up, but the consolidation we get over the next few days and weeks will dictate if this continues or we fall back right back down. So usually markets don't trade like this all the time. It's very hard to sustain a quality uptrend with V shapes all over your charts. Sometimes leaderships keep rotating. That's a good point. Energy is leading while market is pulling back, and then market continues to pull back, and home builder services are leading. How do you manage that? I think that's a really good question. I would say energy names, home builders are a lot more macro-based groups that are dependent on also the currency markets as well. So usually you want to learn that side of the market when it comes to those groups. It's not as easy as tech stocks or solar names or some of these others where they have predictable factors that kind of drive price action or predictable, estimates or growth. So when currency markets and the dollar get involved, things get a little bit harder. That's why the energy trade is probably one of the hardest trades in the market, or the gold trade is one of the hardest trades in the market. So when this happens, I would say maintain that ETF list that we spoke about, place proper ETFs on that list, do the research and find ETFs that are equal weight that will give you a really good idea. And then once you have that sorted by absolute strength, right, is what I do. 1 month gives me a really clear picture of rotation in the markets. And usually I don't tend to trade energy because it's very gappy on the charts, but uranium, crypto, those spaces, I really like to trade as well outside of the general technology stocks in the markets.
Yeah, I'll add on that. In my leadership list, I try to have kind of
It's still
representatives from multiple different leadership groups or themes that are showing themselves in the market. So even if there's rotation in between those groups, I'm kind of always seeing where that's going, if that makes sense. So I kind of, if energy is a leading theme, I try to have two stocks from the energy space on there. If software is also a leading theme, and software is strong in a day where energy is weak, I'll see that in the leadership groups. So the potential leadership groups, Rai, that's a key thing that you really emphasize for me, and I think it's really critical. Try to have representation in your watch lists, as well as in your leadership lists from multiple different potential leadership groups.
Perfect. Wondering how our routine might be modified when you're working a full-time day job. Any chance of a webinar in the future to manage portfolio since so little time is available during market open? Yeah, I think we should take up, I'll make a note of it. I think there's a lot of,
Demand for
we
that.
should probably like dedicate something to folks that work full time, and maybe even have, because I know Jack, Jack Alpha Charts, he works full time. Maybe have him on and give us a few tips on how he's doing it. I think some dedicated resource for that is definitely a good idea.
Yep. There's a question: do you watch HVE on weekly or daily charts?
Daily. Weekly charts, look for monthly charts, look for 1 billion in volume. That's a really good scan to run. Weekly charts, I don't look at HVs on weeklies. I've mastered them on daily. They might happen on weekly. You might get like a big down day, and then you get a big up day, and then you have rebalancing, and there's a lot of factors that aggregate things into a week. That's why I just keep it on daily, because I want to know the exact catalyst, why it happened, what's the surprise, what caught the market off guard. Those are the factors that are really easy and visible on the daily. There is a preset for high type flag and deep view. It's under presets and deep view, if that helps.
Yeah, that was developed by Leif Serede, who's the king of high tide flags. So yeah, definitely check that out.
How do you guys use heat maps for screening or watching rotation? I don't use heat maps all too much. I think it's a good visual to have, for sure, to on a daily basis to take a look at. In deep view, what we are going to do is you can have a heat map of your universe list, or you can have a heat map of any list or screener pretty much. So that will be pretty interesting to see how those come out. But I'm not a big user of heat maps at the moment, on a daily basis.
Yeah, I think they're a fun visualization that can help you spot rotation, but if you want to be precise, you kind of have to dive into the stocks themselves almost.
Yep. How do you set up extremely helpful? Marcus Smith has it. So any deep view questions, join the Discord. If you're a subscriber, you have a dedicated Discord. You ask a question in there, we'll answer it almost right away, right? We have a whole team that has notifications set up, so deep view questions can definitely go there.
Yeah, and you
Well,
can also email hello@dpu.com and we'll try to answer them there. There's a question from Bob. How many screens you feel should be run on a weekly basis? With the amount of preset screens available in DPU, it can get really overwhelming and cause confusion. For me, each week, I kind of run four main ones: the DPU Universe screen, the DPU Leader screen. I've got an IPO screen that I run as well. And then I just created a power and tightening screen, which looks for tight areas with RMV. So those are kind of my main four or three. If you only had to choose two, I would suggest the DPU Universe screen and DPU Leaders. You'll catch most of the market leaders through those. So that those are kind of the main ones I look for. And then Rai, you have your three main ones as well.
yeah, so with the presets, the idea with that again is to give you guys what we're gonna have presets for every trader almost, like what they use eventually. So it's you pick and choose. It's based on your style. You could duplicate them over and make them your own, right? At the end of the day, we're just trying to give everybody, different style of traders more options, and then you could duplicate them over and make them part of your routine based on what makes sense. Um, Thinking about Ross's strategy, the 2150-65, basically the Launchpad setup. The RS trend could be declining when what else could you be looking at to reassure that it has low risk? So the Launchpad setup itself is when you see a whole bunch of charts in the same group exhibit Launchpads, that means that group is getting ready to potentially move up the right side, right? So that is one way you could say, hey, a lot of cybersecurity names are doing this. A lot of gold miners are doing that. A lot of uranium names. A lot of in end of 2021, a lot of energy names built launch pads. So that's another way for you to say, hey, rotation is going in. There's a proper base that's built out for this whole group. And that's how themes also develop in the market. So that's one way to increase the probability when a whole group is lining up at once.
There's a question about my favorite setup. So my favorite is a range breakout up the right-hand side of a base, typically when it occurs right near the 21 EMA. That's what I find captures most of my biggest winners, especially if it works right away on volume. And that works best when we're just starting a market cycle. So that's kind of my favorite overall setup. Rai, is yours the gapper HVC? That's kind
Yeah,
of
my top one is very easy, simple, like just big volume gap ups. Is they give you a good gauge on if the market's healthy. You'll get a whole bunch of them, and then usually I operate within that. I've simplified quite a bit to a point where if a stock gaps up 2.5 months later, it's built out a proper base. I'm still trading based on that HV at the end of the day. So it makes it very easy for me to just have those names come through, track them, and then entry tactics come into play, right? Consolidation pivots, base pivots, etc.
yeah. For Marius, do you think it's possible to accelerate the learning curve by day trading indexes and then apply these rules on a different time frame? Um,
Day trading indexes is the hardest thing you could start with. It's almost you're gonna torture yourself. Don't do that. I would even say go try it, but it's not the best thing you could be possibly doing. Futures are even tougher because risk opens up quite a bit. But anything oil, currency, macro related when it comes to swing and position trading are the hardest ways to become a trader that just uses a couple of things at the end of the day. But yeah, go try it. But I don't start with that. I would say stocks are much easier. And I'll be the first one to admit that. Stocks are much easier, right?
if you're trying to become a professional quarterback, you're not going to start by training to be a wide receiver. Train for the style that you want to be applying for decades, I would say. Um, yep. Okay. Let's see here. Joan, will you develop a drill down DP list? Yeah, we're gonna have ETFs. Yeah, you want to talk about that, Rye? Because that's an exciting thing with the DPU, the ETF breakdown.
Yes. So that should be out, I would say next week. No promises, maybe a couple of days later than that. But you will be able to click up next to ETFs. There's going to be a small H. You click that, and it will show you all the hold. It will show you all the holdings within that ETF, and then that's going to be a super quick way to. Let's say you have a solar ETF. You click it, and it will show you. You could go flip through those charts. You click X at the top, and you'll go back to your previous state. So we'll have holdings for every ETF, and they update daily. So.
From Glenn, do you use buy stops or alerts? I use alerts, but when I was working full time, I did use buy stops. So I would use alerts and buy stops, and that's definitely a way to do it. In an ideal world, you're able to watch the stock as it's pushing through a pivot or whatever, but sometimes you have to use a buy stop. And Nicholas Darvis had tremendous success using buy stops, so it's definitely possible.
Yep. Thank you so much. I'm grateful for your help. Looking forward to the undergraduate training. Awesome. Any fundamental parameters for trading, or is it just technical only? Definitely, I use estimates a lot more now. So like quarterly estimates turning positive or increasing is one really good tell of how bases are built. That's an ongoing study, or things that I'm starting to notice in a good uptrend. Stocks trade on future potential, and how analysts view that, as how institutions view that kind of shows through the estimates as well. So that's one thing. Obviously, sales growth is a big driver for names in the software space over the past couple of years. First time positive EPS, or EPS turning positive for the very first time, is another thing that I tend to look at. So I use a lot of the basic can slim stuff when it comes to fundamental parameters. So that's all valid. We may not have talked about it much. We have in bits and pieces, but it's definitely an important component.
Yeah, earnings growth, sales growth, acceleration in that, and then estimates. Estimates are almost more important than the historical. I look at the previous 2 to 4 quarters, and then the estimates the next 4 to 6 quarters. That gives you a sense of what institutions and analysts are expecting the growth to be, because that's what the stock will actually be trading on, is the expectations of future earnings or sales growth.
When they're bad, just take a look at what happens, like Bill this past week, or FDNT. They gapped down quite a bit. All they did was they said that over the next quarter they revised down their revenue, right? And they gapped $30-40 in a matter of minutes. So a lot of stocks do trade on what companies say their roadmap is, and what analysts see or what institutions see as their roadmap. Are they big believers in their story at the end of the day? There's a good question here are all your trade ideas determined before the open, or do you sometimes make in-game decisions when taking on a position? Really good question. I think stage 1 and 2 traders should always have all their trade ideas be determined before the open. That will allow you to execute a lot better and get to stage 3 a lot quicker. In-game decisions, or when the market's open and you come up with an idea on the fly, I've done it. It doesn't work. There's a lot more emotion that comes through, and you make a lot more mistakes because you make bad decisions and you haven't game plan for any of it. So taking your trades before, determining your trade ideas before the open, again, could be a non-negotiable rule for stage 1-2 traders.
Do you use options? Any reason you use or don't use them? I personally do not, simply because I haven't really studied or learned them that much. I grew up on stocks, so in the future, I imagine on a breakout that I have high conviction in, I might try to increase my position size synthetically through some options or hedging portfolio. Later on, if it's a big position that I want to hold longer, I might hedge kind of like Jim Ropel when a stock is falling back to 50 SMA. But yeah, at the moment, just stocks and shares for me. Rai, any thoughts on that?
Yeah, when your positions, when you're trying to build a position that you want to hold over multiple quarters, the options market becomes much more lucrative, because you could go out and buy very extended options which you can then exercise and convert into stock later on. But starting out with a small account and then going into options is tough because it's almost like those, when they introduce 3-time ETFs, they know that they decay over time, and a lot of people are going to lose money on them, but they do it anyways and they promote them, right? Options trading is kind of similar. That's why I'm saying I'll be the first to admit stock trading or trading stocks in the market is the easiest avenue to get started. Options, futures, indexes, leverage stuff,
Penny stock.
commodity are these are all harder at the end of the day. These things are much, much harder because the amount of knowledge, experience, factors increase quite a bit when you get into these spaces. So
Yeah, and there's a similar question about small cap penny stocks, but it kind of if there's added risk, it's tougher. There's a lot more volatility with those names.
there's very bad, bad things that go on in that, very small micro cap names. There's, people, social media campaigns, email campaigns, buy this, people promoting stocks. They really have no future or story, right? When I started out, I went down that hole too, and I know exactly how that feels because you're just trying to chase that pot of gold at the end of the day, and they make it very easy to leverage that emotion off of you and give you a promise that this and that's going to happen. Microcaps, at the end of the day, they all go to zero, and they're microcaps for a reason, right? And the biggest companies are the liquid leaders, or the ones that institutions are trading are there for a reason. Be it dividend stocks or high growth stocks, they have some value to it, and there's a reason that they're not microcaps. So.
Yeah, there's a question about kind of foreign markets. I focus on U.S. markets exclusively. This is where kind of the most innovation and growth stocks, the best growth stocks are. I think India is really interesting. I think we'll see more opportunity there.
Much
Yeah.
much easier to trade as well. The Indian markets, the patterns that I've seen based on folks I follow and some of the scanning, it's a lot cleaner. It's like the early crypto market where you would draw, a consolidation and then it's gonna go, right? And it's very young market with lower volume as well. But very clean patterns early as markets mature, pat it gets a little bit more complicated, but these crypto markets and the Indian market trade very clean patterns. And all of this that we spoke about is all applicable to any market in the world. So
How do you scan/figure out which group is breaking out? Please elaborate. I guess, talking about rotation, um, I'm looking to see where the strongest stocks in the market are, what themes they share between them, and you can also, of course, use the industry group rank. That's a great, objective data point to check that out. But just watching individual stocks, if you notice that 5 semiconductor names breaking out a basis together, that says something about the overall theme, the overall group that it's acting well. Or likewise on the flip side, if software stocks start breaking down altogether, you'll see that in the stocks themselves if you keep tracking those growth names. Anything that you want to add there on like tracking rotation, right?
yeah, I keep it simple. ETF list. Patrick Walker has a few videos on it. I would go watch those. Build your own ETF list, sorted by absolute strength, 1 month, and DPU. If you don't have DPU, make that list and sort it by percent change, 1 month, 3 months, or something. That will give you a similar reading, right? Of where money is flowing into. The important part is including ETFs in your list that represent what you think they're representing. That's the key. So if you put a blockchain ETF that's primarily based on a Bitcoin index, that's probably not a good reflection of Bitcoin stock or crypto stocks and how they're acting in the market. So knowing what ETFs you're including in that list and what the holdings are for each of those ETFs will help you quite a bit, because when you see those things, when the absolute strength score on some of these gets above 90 and they move up to the top of your list, you'll know exactly where the money is flowing into and you'll act a lot better that way.
Yep. From Mickey, do you, Rai, or Richard trade actual crypto Bitcoin or just stocks like Riot, Coinbase, MSTR. I haven't traded any actual crypto again because I'm not really familiar with like exactly how to do that. Honestly, I've had some good trades in the GBTC, which is it's not an ETF, but it's a proxy basically.
Yeah, it's okay.
I've traded pretty well Coin, MSTR, a few of those names. So, Ryan, I don't know if you've traded any.
I've done both. Again, I would say stocks are much easier, more lucrative. So some of these stocks can move 30 to 40% when Bitcoin is only moving 10 to 12%. So you get more alpha or more beta out of these names. So again, it's much easier to trade, a Coinbase versus Bitcoin futures because Bitcoin futures are open 24/7. And your lifestyle goes downhill when you try to do those. I did try them early on just because, you know, but I don't do that anymore.
Yeah, maybe we should talk about that a little bit when discussing rules. Is like plan some vacation, some time away from the market. Almost, it will help your longevity and mental state and all that. You don't want to be thinking about trading all the time, especially when you get to past the intense learning phase where you're learning the basics of everything. Um, Especially when you're not trading particularly well. You want to take some time away, go do a hobby that you like, go exercise, all of that. It's good for your mind, your health, and eventually your wealth because it'll make you trade better overall. Let's see here.
How long did it how long did it take for you guys to be consistently profitable? For me, I would say north of 7 years. Um, And I went through again the whole currency, commodity, index, ETF, leverage, the whole journey of let's go back. Microcaps was the first thing. So I went through all of that stuff uh, to get to this. So it took me north of 7 years.
Yeah, it took me.
Richard is he started with the right way. So
Yeah, it didn't. I was also blessed by good markets during a lot of my learning phase. I'm still, in my learning phase, but it just took me a year or two to really get a handle on things. But if you start learning from people who have done it, I've been really fortunate to learn from some stellar traders, Rai included, that have really shortened my learning curve. Dr. Wish initially, you know, if you start with a focus on risk management, you can really cut down that time. But there's still the transition from stage 2 to stage 3 where you're performing, you're reaching super performance level. You can quickly, I think, get to stage 2 just by you know um, getting the right resources, taking master classes like what we offer, watching webinars like these. But that next step takes a little bit longer, and it takes market cycles under your belt to refine your system and process and all that. So it's going to take time, but again, a few years of your life, even 5, 10 years, if you can learn it and do well after that, you've got decades to um, for those dividends to pay off all that work, all that hard work, that process. You can really compound your capital. So it's worth the effort, I guess, is what I'm saying. And John Boyk, in his masterclass, he talks about many of those stellar traders took 6 years to become profitable. So it definitely does take a journey. Let's see here. Um, there's a question from Les. Rye, where's the best place to find implied move? We really have to get that in deep view as well. But
best place to find an implied move. There's a website,
Option Slam.
optionslam.com. Yes. Optionslam.com, and we'll get the calculation in deep view soon. So we have access to the data, we just will add it.
Yep. All right, let's see. We'll answer a few more here. Thank you guys all for the excellent questions. Hopefully, these answers are helpful for you guys, and probably a lot of people watching the replay as well are thinking similar things. Let's see.
Yeah.
Philip asked for the most. Oh, did you have one? Go ahead.
No, someone said Thinkorswim has implied move. They do. That's true.
Philip asks, for the most part, to avoid volatility, do you both start your trades after the first 5 minute bar? It just depends for me. I think a lot of my trades are placed in the first 30 minutes. It just depends. What's the type of day? Is there an expectation breaker going on? Is there an individual catalyst with the stock? Price action is price action. You can kind of judge the move, looking at the volume run rate, looking at the power of the price action, all that stuff. So it might be helpful early on to place kind of restrictions on that, just because there is a lot of volatility that you might not be able to see through as well if you're earlier on in your journey. But there's a lot of opportunity in those first 5 minutes. There's people who only trade the first 5 minutes.
I don't, I mean, what I tend to do is, for me, price is more important at the open because the pattern is already in the back of my head as to what the pattern is, where I want to enter. So I know if, a stock closed at 24.80 and is opening above at 25.30, and that's one of my pivots in the back of my mind, I know exactly where that chart is, and where it is, visually on a 5 minute, 15 minute, etc. Right. So that I tend to pay more attention to the price movement and the number than looking at the chart to make the decision. That, in my opinion, should also be offline because you look at the pattern, you look at the structure, and all of that should be done. And when the market's open, you're looking at price and you're focusing purely on execution. You're not going there and looking at 5 minutes and then doing your homework after your pivot has triggered. So a lot of people get it backwards with respect to that. How to manage risk if a stock is making higher high and higher low on 3 consecutive days? Again, this is a very generalized question. Develop I would say develop some sort of entry tactic around that and visualize it and find 20 to 30, 50, 80 examples of this that you've described, higher high and higher low for 3 consecutive sessions, and make that an entry tactic for yourself because it's very hard to say what is the risk. A stock's range, average daily range, can be 15% or 10% or 3%. So your risk will be dependent on that. And then depending on that average daily range, your position size will be reflective of that risk that you will take on that day. Let's see. If you don't have time to answer these, please. I'm not sure. That might be part of some other question. Is there a place to download the slides? Did you think about publishing an Ultimate Trade Guide as a book? Interesting question. So we will have a book sometime next year, fingers crossed, which will have a lot of the contents of Ultimate Trading Guide. There will be a book, and that will be from the entire TL team. So Richard, Ross, Nick, and I. So that's interesting. As for downloading the slides, they will be available for sure as part of the UTG Pro. So we'll make all of these resources and downloadable slides available through that resource.
Yep.
Please explain IOF. It will take quite a while, Mickey, to explain IOF. And IBT is basically institutional options flow and institutional block trades. We will have those modules sometime next year in Deep View. It's just information where large trades are placed and how they result in directional movement in the markets. One's related to the block trade market, which is when a trader goes out and purchases 200,000 shares at once as a block trade. And the other is institutional options flow, which is related to the options market.
Yeah, and we'll look forward to diving deep into that in the Rai swing trading masterclass whenever we put that together. Perfect. I don't see too many more questions coming through. Let's see here. So the Trading Guide Pro, it will be a class. It will be a course that we'll create. So it's not in guide form. It's got videos, it's got articles and examples, quizzes, that type of thing. So that's the format that it will be in. Let's see. I think that's a pretty good spot to end it, Ryan, unless you see any other pressing questions. Les says, for those of you asking for a free week of DeepView, please go ahead and spend the $50 a month. There's a lot of information on DeepView in 1 week. Won't give you enough time to really appreciate it all I can do. I agree. There's a lot of features. And if you're going to try out DeepView, I'd also highly recommend attending all of the tutorial sessions because that will help give you a kickstart and really see all the features that DeepView has to offer. Perfect. Let's see. Additionally, I do want to mention that the promo code for the master classes, UTG Savings, that's available only for the next few weeks. So make sure to check that out while you can. Really, I think if you want to take the next step and really shorten your learning curve even more, those master classes are the way to do it. I think they're the best trading resources out there, and we worked hard to make them each an excellent experience. All right, right. Any last words that you want to wrap up?
No, I think we've done a heck of a job over the last 9-10 weeks. This concludes that. Be on the lookout for UTG Pro. It's a step up above what we did over the last 10 weeks. It's almost like a one-on-one going through each framework, giving you more exercises, content, deliberately structuring it in a way that you build each framework as you go. And that's the purpose of UTG Pro. We'll likely have 2 levels to it, level 1 and level 2. That will be out in a couple of weeks from now, and I'm sure you guys are going to love that if you love the last 10 webinars as well. So with that, I think we can end it there.
Yeah, I just want to thank everybody watching and especially everybody who attended all the different 10 sessions. This has been a really fun experience for us as well. And, making these presentations always helps us reinforce our key concepts and helps us become better traders as well. And you guys have, given it all, attended, asked some great questions. So hopefully this has helped you guys out, and just want to thank all you guys watching. So if you're watching the replay, please leave a like down below, subscribe to the channel, ask any questions you have in the comment section. But thank you guys all for attending, and hopefully this has been helpful.